So good afternoon, welcome, and thank you for joining us. I think we're actually going to start promptly because we only have an hour and this is a very big topic to get through. My name is Ellen Davies. I'm the Senior Research Advisor at the African Climate Foundation, and I'm here with Salim Fakir, who I believe needs no introduction. But for those of you that may not know him, he's the Executive Director of the African Climate Foundation, and Matt Huxham, who is the Director of Climate Transition Analytics at Willis Towers Watson, and who co-authored two of the reports that we're launching today with Mohammed Anwar and Patrick Neary. So the plan today is really to pick up on some of the key questions, issues, risks that have emerged from the ACF's research, and to have a conversation about what this may mean for gas-rich countries on the continent. There'll be a little time for questions at the end, so please do post any questions that you have in the chat, and we'll try our best to get to them. To begin with, I think it's important to give you a little background to the research and what we as the ACF were seeking to answer. So even before the outbreak of the war in Ukraine, there was significant activity around gas in Africa. Between 2011 and 2018, around 40% of global gas discoveries made were on the continent. And there's been much excitement about these discoveries from governments and from people because they're seen as an opportunity to meet domestic energy needs, to support industrialization, to increase foreign revenues, and to support local development. But there are also a number of risks. The most obvious being that gas is a fossil fuel and that the world is transitioning to a low carbon future. So as the ACF, we wanted to understand what these discoveries actually meant for different African countries, both in the immediate term, but also in the longer term as the world transitions. We're very, very proud to be launching 3 reports today that capture this work. The first is a discussion paper titled Just Energy Transitions and Natural Gas in Africa, Balancing Climate Action and Structural Transformation. The second is a technical report that explores the transition risk for 12 gas-rich countries in Africa, titled Natural Gas in Africa Amid a Global Low Carbon Energy Transition. And the third is also a technical report that dives deeper into the transition risk in Mozambique and Tanzania, titled Natural Gas in Africa Amid a Global Low Carbon Energy Transition, a case study of Mozambique and Tanzania. All 3 reports are available on our website, and I believe Kelly might already have posted them in the chat. Before I move to Salim and Matt, I want to make a couple of framing remarks to guide our conversation. The first is that for us, there's absolutely no question that the onus to rapidly mitigate greenhouse gas emissions must be on the developed economies, given their historic and continued contribution to climate change. The hypocrisy of countries and regions in the global north who continue to emit the most, yet call for rapid decarbonization in other parts of the world is not lost on us. There's also no question for us that for African countries and indeed the rest of the developing world, decisions about their future energy mix and industrialization and growth strategies must prioritize the broader socioeconomic development needs of their people. We have to be able to electrify, we have to be able to grow our industries, and we have to be able to develop our economies. Having said that, in making important choices about our energy future, we cannot lose sight of 2 important realities. The first is the global transition currently underway and the inevitable implications that this will have on the sustainability of our investments. It's abundantly clear that powerful countries and blocs are currently readying themselves and their economies for the transition, acquiring access to critical minerals, developing manufacturing capabilities, securing new markets for their technologies, and putting the regulatory frameworks in place like the Carbon Border Adjustment Mechanism that will penalize exports from fossil fuel dependent countries. So while Europe, for example, looks to African countries to fill the gas gap left by Russia, it's also putting in place measures that will ultimately end up penalizing those countries that come to its rescue. The second important reality that we cannot lose sight of is that while the onus to rapidly decarbonize must be on those in the developed world that have contributed the most to greenhouse gas emissions, Africa remains the most vulnerable region in the world to climate change impacts. Across the continent, we're already witnessing the impacts of climate change. Rapid global decarbonization is therefore imperative for our socioeconomic sustainability as a continent. I'm gonna stop here and hand over to you, Salim, and ask you to help us set the scene. Can you paint a picture of the environment in which decisions about our gas future are currently being made? So coming out of COVID, what's the economic landscape looking like in Africa? What are some of the challenges that African countries are facing? And why in the current context in particular is gas so appealing to resource-rich countries?
No, thank you, Ellen, and also welcome to the participants, and really congratulations, Ellen and the team, also Matt, for putting out these reports. I think they will be a valuable resource for the community as a whole. I think the important thing to recognize is that we're just coming out of a post-COVID phase. There is still high debt overhang generally in the continent. People would have heard about Zambia, for example, which has to resolve very high debt levels at the moment. Economies have to recover. Those who are highly dependent on minerals, oil and gas require a commodity boom in order to be able to earn the foreign reserves, be able to pay for, to increase the fiscal coffers and to be able to spend, most importantly, having to spend a fair share of each dollar on debt service costs. Many of them are moving into an inflationary era, and where the cost of money is also less cheaper than what it was before, and this is a global situation. And then you have the crisis of the Ukraine war. So we do say it benefits oil and gas countries, but it also has an impact on the continent as a whole. If you take into account devaluation of currencies, the import of food, the need to pay for things that are much higher cost than before, and being able to draw down savings from the global community to be able to put new infrastructure. There's a new constraint in the world. That constraint is not just about the financial situation, it's about economic growth, but more importantly, going forward, Africa needs cheaper sources of capital to be able to make the kind of energy investments that is necessary. So oil and gas countries that are mature are benefiting huge. These are mature oil and gas countries. They're still emerging, and new finds that are coming into the in the pipeline of the exports. But there's huge uncertainty also facing us going forward. Those who are able to milk it now will be able to do so. Those who think they might be able to benefit in the future may face some huge uncertainties going down, especially if you do have a crisis at the moment that is scurrying for oil and gas reserves in the world. Depending on the kind of contracts that are signed. If it's short term, there's a very limited positive investment environment for new kinds of LNG terminals and gas pipelines and infrastructure. And if you build them with long horizons in mind, you're likely to find yourself to be more indebted if the demand drops, let's say after 5 years. Because simultaneously to the crisis, there's also a ramp up in renewables, in battery technologies, in electric vehicles, more efficiency in the use and consumption of energy. Prices are actually pushing people to think more of reducing consumption. And then you have the challenge of the cost of capital. Those scenarios are what we're living with. So main message here is if you have mature oil and gas fields, you are feeling very rich and well. if you coming online thinking that you will have a commodity boom in the future, you may have to think twice about it, because there's huge uncertainty and risk in those investments. And I think Matt will talk to that. And thirdly, I think that if we are moving into a more decarbonized world, we have to have better strategies than just depending on fossil fuels. To think that we can plug the hole just by exporting more fossil fuels. We actually have to, if we can take advantage of them in the short term to benefit us, but actually diversify economies, we ought to invest in more cleaner technologies that are at more lower cost, and to not rely on subsidization from the exports of fossil fuels in order to generate electrification and economic growth. I can say a lot more, but I'm just going to leave it for there now. Thanks.
I think that's great for now. Thank you, Salim. Matt, over to you. I think my question is, with the high gas prices and the shift in the positioning around gas, particularly from Europe, this has been incredibly appealing for African countries, but your modeling is forward-looking and it paints a different picture. So for the 12 African countries that we looked at for this study, what are some of the transition risks, and particularly for countries looking to develop new resources?
Thanks, Ellen. So maybe I'll just start with a little definition, because I know that the phrase transition risk means something to some people and not very much to others. So what we've done with our modeling, and we've used our in-house commodity expertise to project out 4 different futures for the global gas market at different speeds and different shapes of global decarbonization. And in those scenarios where the global gas demand is lower, so in the event of a transition in line with the Paris Agreement, for example, then producers, of all forms of gas, and oil and coal actually, end up facing potentially a combination of lower future sales volumes and lower prices, and therefore lower profits. And so the difference in the economic value of a country's gas industry between the current trajectory and one of the lower carbon, faster decarbonization trajectories is really the transition risk that we're talking about. So in that context, and actually you'll find 4 scenarios in the report. On the low carbon side, we have a 2 degrees and a 1.5 degrees scenario. We find important differences between producers, depending, not only on the costs of production, but also on one of the key variables is whether those producers are already producing, and therefore they may have already paid back their initial investment in infrastructure, or those who are considering developing these new industries. And I'll give you an example here. One of the countries that we looked at in a lot of detail is Tanzania, who signed an agreement with international oil companies last year to move forward their developments. And they're talking about first gas potentially in 2029. So the lead times are significant for these producers. And the existing producers face differing positions. So for example, Algeria has a couple of different export channels, both by pipeline and also with LNG, which is different from Nigeria. Different domestic positions that are related that we'll come on to in a second as well. On the emerging side, we found that for Tanzania, the value of the industry between now and 2050 would be 69% lower in a well below 2 degrees scenario than the current trajectory. And in Mozambique, 61% lower. So for African countries and governments, betting on these revenues as potential future sources of foreign exchange, taxes, jobs, for example, the reality in a world that complies with the Paris Agreement could be very different from what they're expecting. And the absolute numbers are important here. So the absolute amount of downside risk for Tanzania is 30% of 2021's GDP. And for Mozambique, it's nearly 3 times 2021's GDP. So if countries create development plans on the expectation of these revenues and then they don't materialize, then actually we potentially end up with much higher than expected public debt and a drag on long-term development. So all of this is happening within the context that Salim set out, which meant that actually for many of these producers, the fiscal space has been significantly constrained. In a previous piece of research into oil in Uganda, we found that international partners were pushing hard, flexing their negotiating muscles to renegotiate better deals for themselves, taking advantage of the weaker negotiating hands that African countries now have. And this is probably likely to happen with the new gas developments as well. So all of these things mean that despite the long-term risks and even for those, even for those countries who recognize them, we may end up with African countries signing deals that end up bringing significant long-term risk because they're bringing short-term cash. So prioritizing the short term over the long term is something that we're expecting to see.
Thanks, Matt. I'm actually going to stay with you, and I'm interested in your thoughts around the domestic landscape. So one of the arguments that's made in favor of developing our gas resources on the continent is that it's going to help meet our energy access gap. What does the domestic gas landscape look like, and what are some of the key challenges associated with gas to power in particular? And what is the prospect of domestic gas utilization mitigating some of the transition risks for African countries that you spoke to?
Okay, so this one is actually a little bit more complex, and the answer really varies between countries depending on 2 major variables that we found from our research. The first one is whether a country or for a particular investment, whether that's reliant on foreign investment for it to be viable. And the second one is then whether the potential and existing consumers of gas in any given country are able to afford that gas without significant public subsidy. So I'll go into some of those points a little bit, but the very high level picture is that it seems unlikely that in most places gas would be a cheap option for meeting these industrialization or even energy access needs. So if we unpack that a little bit, so obviously developing gas resources for domestic use and not just domestic use but also for regional use. I know that there's quite a few regional pipeline initiatives happening in both West and East Africa. For those producers, they will be subject to some transition risk, right? So even if we're talking a country like Nigeria, which is looking to expand its domestic use of gas, Nigeria may face less international pressure to decarbonize as fast as some countries in the global north, but there will be long-term risks that producers need to take into account. For existing producers, one of the challenges with scaling up domestic demand is that, and here I think this is relevant, certainly for Nigeria and Algeria, also to a degree in Egypt, is that at the moment consumers are facing subsidized prices. So existing producers are able to rely on high export revenues now to cross-subsidize those prices, and that means that in a world where we have faster global decarbonization and lower export revenues, not just for gas but also for oil, which is relevant in a number of those countries, then actually it starts to become potentially much more expensive for governments to subsidize those gas prices, and that means ultimately that gas is a economically less advantageous source potentially. In isolated places where new developments are dependent on foreign investment, then we also see the challenge whereby foreign investors may prefer actually, they prefer to export, not just because they have access to higher prices, but also because they potentially export in dollars, because they're accessing markets that are maybe they perceive to be geopolitically more secure. And so actually for a number of the countries, and Mozambique was one of the ones that we looked at in detail here, the regulation that puts in place the requirement to supply a certain share of gas domestically could even put off foreign investment in the first place, right? So we've got two different paradigms potentially, and even in those countries whereby which are or developments which are less reliant on foreign investment, domestic prices are still unlikely to be high enough to support those investments by themselves without significant increase in subsidy. So we found that, for example, in Tanzania, over a period between now and 2050, the country might need to spend up to 60% of the gas revenues that it might cumulatively earn from exports just on subsidizing domestic industrialization if they choose to go on down a gas-led route. So it's not so simple ultimately to say that gas is cheap, because we see that in many cases it's not, when, and particularly when those export revenues are not there, they cause, and the absence of those revenues potentially cause fiscal and trade balance issues.
Fantastic, thanks, Matt. Just a reminder to everyone to please post questions in the chat or the questions and answers box. I think we're actually going to have more time for discussion, so please do post your questions. Salim, Matt raises some very important points about the need for subsidization in many countries to make gas competitive on domestic, excuse the motorbike in the background, to make gas competitive on domestic markets. When we look at the price of renewable energy alternatives, when we look at the fact that prices will continue to drop, what you outlined in your introduction, as well as the fact that we have great renewable energy resources on the continent, we have huge energy needs. Why is it that renewable energy scale up has been much slower than expected?
I think, Alan, you and I were involved in a particular study in which we looked at Chinese investments in the renewable sector. And, we were struck by how low the level of renewable, and we're talking about not hydro here, we're talking about wind and solar PV, and also concentrated solar power, how low the penetration was on the continent, particularly given its very generous and abundant resources of wind and solar, which, by the way, is a very important factor in the cost of generating electricity from these resources. For example, Namibia at the moment is one of the second best wind resources in the world. It's one of the reasons why there's such a huge interest in using that resource, perhaps not for electrification, but for electrolysis, for the generation of hydrogen. And I understand some of the best capacity factors of wind resource capacity anywhere in the world, besides the solar radiation that, if it was to captured, particularly in Namibia, it could generate more cost-effective electricity. So there are resources, natural endowments on the continent that don't require us always to have the sort of ideological position that we need to run to gas and fossil fuels because we have to defend this as some kind of nationalistic thing, but we should be more prudent. Look at those options in a far more scientific and evidence-based way and say which of those options allow for more flexibility in the system On one hand, countries may want to choose in the short term, use the advantage of the demand for gas, but not consume those resources to subsidize further gas consumption within their domestic environment. In fact, Algeria and Egypt are busy looking at ways to wean off consumption. And I would say that's also true for Nigeria, domestic utilization of the fossil fuels, because they can at least exploit the demand for exports in order to maintain sufficient reserves and also be able to have healthy and sustainable budgets. What they then have to do is invest in cheaper sources domestically, but it's very important that the domestic economy also shifts to more diversified economy. If gas and oil is a depleting resource, they have to find other forms of exports. There's no point in taking windfall revenues from oil and gas, and all you're doing is you're making consumptive investments. In other words, you continue to deplete not only the resource that you have, the endowment, but you also deplete your wealth that you've generated from the conversion of that endowment into cash, for example. And you are not investing the cash into more productive assets where you could generate other types of economic activity and higher value economic activity in which you can export food or other industrial equipment or other things to the global markets and also regionally, for example. For example, if you notice that our inter-regional trade is still small, it's like 16% or so on. So there are huge advantages in us building higher value industrial manufacturing services and so on that are more exportable, tradable, than just relying on an endowment that is a declining resource. We generate cash from it, and then we don't invest the cash into the right places, and we continue to dig bigger holes for ourselves as we go forward. So I would say dealing with gas should not be in isolation of the broader economic transformation debate that we need to embrace on the continent. And that broader economic transformation debate is no longer just a binary debate about gas versus renewables. It's more about finding the cheapest source of electrification. And finding the cheapest source doesn't mean you must continue to subsidize it, because that's encouraging a moral hazard in the sense that people will use the subsidies not for necessarily productive purposes. So that's why also reducing subsidies enables economies to become a lot more efficient in the utilization, even of fossil fuels for that matter, or even if it's electrification from renewables, and try to invest in things that can add more value to the economy and the regional and global economies. This is the direction we need to go. And lastly, just to say that we are going to face a carbon-constrained world, and where the uptake of new technologies, electric vehicles, cleaner energy solutions, storage technologies, will gain primacy also on the African continent. If we can improve the economic condition in the early phase, we have to recognize that, as our studies we've done showed, that the capital cost for generation of even from renewables is still very high on the continent. But improving economies, the capacity of the economy to generate more productive value also improves the ability of the countries in them being able to raise cheaper sources of capital. And given that they would have improved income, they would have more domestic savings, which then becomes a lot more easier for them to fund their own infrastructure projects. So we do have a challenge with renewables, even though it's really the alternative we need to go to, in that we have to also find ways to reduce the capital cost and reduce the need for importation of the technology, and to find ways to actually utilize even the endowment of critical minerals to at least manufacture and produce many of these technologies on the continent. But in the early phase, we're going to have to borrow to be able to do that. And then we have to increasingly indigenize renewable technologies in order to be able to sustain higher thresholds of it without having to borrow more and more to fund foreign coffers, when we should be actually finding ways to pay for this and to retain the value of these investments internally within the continent.
Thank you, Salim. I think I'm going to stay with you. I think you raise a few very interesting points. I mean, clearly there's the kind of at the domestic level, there is the will to scale up renewables, but there's also a question of access to finance. And as we head into COP, what do we as a continent need to be doing and what models are potentially available to us to start to scale or to start to access greater quantums of finance, climate finance, to support renewable energy uptake?
Perhaps the one that comes closest to mind, because I'm very close to it and I have a more intimate knowledge of it, is the Just Energy Transition Partnership in South Africa. And of course, there's a lots of challenges with that, and there are lots of debates still to be had about the financial package. But let us for a minute leave that aside and focus on what the deal is all about. In one respect, what it does is that South Africa has put out a more ambitious carbon reduction trajectory going to 2050. That ambition requires support from the international community in order for South Africa to be able to meet its new ambition. And South Africa's current debt service costs are high, so it needed to find cheaper source of concessional finance and potentially also grants, and try to ensure that the 8.5 billion that it was able to raise, that it is much more competitive financing than what the South African government can raise on the global bond market, for example, in which the interest rates are far higher. So if you can get it 1% and less, bearing in mind the exchange rate devaluations that can happen, that public finance can put to good use. South Africa has proven that it can, with the right policies and structured programs, it can also utilize its vast domestic savings to finance a renewables build program. Hopefully those things, those injections of those investments will improve the economic climate, induce a more healthy growth, and hopefully over time South Africa's credit ratings would also become stronger, and its borrowing cost of its state utilities and the national government will also drop. So we need to go into this what I would call a positive cycle of economic growth in order to what people call the virtuous cycle. You create a virtuous cycle out of a non-virtuous situation, and that virtuous cycle hopefully helps you to build resources, competency, capability, and also reduce your borrowing costs over time. And we hope that similar kinds of journeys can be embarked upon in other countries like Senegal, Nigeria, etc. And the depth of the fiscus and their own markets can accommodate the ability to finance at much lower cost, the generation capacity they need. And there's huge advantage if they can get the capital cost down. There's massive advantage of taking advantage of the lower the cost reductions in renewables that is already happening. The challenge we have is that we are moving into the inflationary period. The demand in growth for these new technologies will grow, and the supply of critical minerals, which we also have on the continent, which is another advantage we're not taking of. And we're focusing too much on gas and not looking at other endowments we have, which is why gas is such a distraction, by the way, because we're not looking at other important endowments we have. If we can find ways to integrate, for example, we have Congo has 70% of the world's cobalt. We have lithium. If we can find ways successfully to integrate this with a very strong renewables program, it will add much more sustainable and sources of wealth, and also solve our electrification problem, which will do far more better for us on the continent than just being totally distracted by the gas debate, as if that is only going to solve everything that we need to have done on the continent. So I think our caution as ACF is really to move away from a bipolar debate, look at the whole picture and say, what are the other endowments we have other than gas that we're not looking at closely, and we should be exploiting a lot more and not thinking harder enough about. So this bipolar debate, which has become so ideological, and let me say on both sides, is not putting us on a footing in which we can have a more holistic view of the opportunities that are there. And I can assure you there are much more interesting opportunities outside of gas and fossil fuels. And we as ACF need to look at those as well. Thanks.
Matt, I'm going to hand over to you. I know that you want to come in, but Salim, just quickly, how do we avoid the bipolar debate? This is something that we've been grappling with at the ACF, but particularly given the kind of crunch and the demand for gas from Europe. How do we...
I do think we need to build a coalition of like-minded people that can help be more persuasive on a more integrated development approach. And we look at all the endowments that Africa has, and then also look at those endowments it doesn't have. For example, it doesn't have cheaper sources of finance. It might not have the technical technology in the early phase, and it needs to recruit that through joint ventures from overseas investors. So I do think that the only way to break that is to depoliticize it, to remove it from the pedestal of ideology, and thirdly, to push the more pragmatic view of a more holistic and integrated economic development model, where we look at all the endowments we have and we push the choices that make the best sense and give us more sustainable economic outcomes, and in which we don't have to continuously depend on one avenue to resolve our economic challenges. We actually diversify, and that we have to recognize that mining and extraction is a depleting resource. It's not a sustainable future, and then we have to build economies that are diversified, that can actually expand the scope of exports beyond the minerals and extractive sectors.
Great, thanks. Matt, I know you wanted to come in.
Yeah, I just wanted to say a few more things about financing, because it's I think it's been one of the key barriers to the scale up of renewable energy in Africa so far, right? So so firstly, maybe I think it's an extremely positive development, this new paradigm potentially of the just energy transition that's been seen in South Africa, and I think we all hope that there's going to be, positive things announced about that soon. And what's positive is that I think it's pragmatic in the recognition that maybe smaller clubs of global north countries might be better able to reach agreement in a negotiation than trying to bring everything together in a multilateral way. And we'll start to see more of these, but I guess I'd slightly caution. What I'm starting to see is that the notion of a just energy transition partnership, or JETP, there's a risk that this becomes another buzzword or buzz phrase, in the same way that we've had so many times before with blended finance and various other sources of finance. What I mean by that really is that the transition issues that each of the countries who might access this type of club financing are actually potentially very different, right? So the situation in South Africa, where there is a lot about retirement of an existing electricity system based on coal and the building of a new one, but where the assets being retired are actually pretty old, is very different from what I imagine to be the situation in Indonesia, where the discussions are much more about retiring relatively new coal-fired power stations. And if we were to think again at one of the countries that we've looked at in a lot more detail, maybe Nigeria, for example, there again we have a very different paradigm where we still have energy access challenges, but we have the issue of economic transformation, and the challenge of this reliance for both fiscal revenues and trade balance on fossil fuels that may decline over time. And so in order to be a strong negotiator in these discussions, this is part of the reason why we always argue that countries, whether they're in Africa or not, frankly, need to incorporate this sort of long-term scenario planning and risk analysis into their policy making. So this understanding what your transition risk looks like, who it's going to affect, and over what time is it going to materialize, that's exactly the sort of stuff that you need in order to develop a well-tailored ask on an individual country for this just energy transition financing. And of course, it's very similar to the sort of long-term planning that is going to be important to help drive industrialization, and in order to capture some of the opportunities that Salim was talking about from the scale up of renewable energy and the growth of electrification. However, and maybe just a final point, not every country is going to access a JETP package quickly. Possibly not every country is going to access one at all. And so I totally buy what Salim is saying about the virtuous circle of economic growth and helping to improve financial conditions that way. But in the short term, we risk potentially, and many of the countries we've looked at, creating path dependency, which creates a vicious circle, right? So if we take the example of one of the countries that we've looked at, maybe it's Mozambique, which is already in a pretty weak position in terms of fiscal space and sovereign credit rating. If Mozambique takes investments that effectively lock in long-term risk and therefore potential future downside in terms of financing conditions, then while it's waiting for its to argue for its JETP, actually its economic conditions are worsening, and frankly it will also put the country in a worse negotiating position for any international funding. So it's a double-edged sword a little bit, I think, and I think we should expect fingers crossed we have a very good precedent set in South Africa, but lots of work to do to ensure that future financing solutions, future investment are, you know, tailored and appropriate for the individual African countries that we're talking about here. And also that, you know, we're not ending up in a situation whereby we have a, you know, a decade of lost economic growth, and then only then a new transition package comes in, because many of the opportunities that we were talking about may be lost by that time.
Fantastic, thanks, Matt. I think that your point about path dependency leads me to my final question to you, Salim. And it's really that if we're to look now at what developing economies or indeed countries like China are planning for over the next couple of decades, what is this signaling to African governments about where the world is moving and where African countries should be positioning themselves on the global value chain?
I do think that a couple of points are on the transition risk issues that Matt mentioned, and I think his points about JETPs are really valid. Every country has its own context, so often, you know, the European Union is a very unified political system. Africa has the African Union, but each country is still governed by its own sovereign political system, rules, legal frameworks, and also relationships with various partners. These are geopolitical partners that we are talking about. But we cannot continue to have enclave economies dominate the future well-being of the African continent. The African continent is going to have a quarter of the world's population by 2050. Many of the people are going to be young. It's going to have high levels of urbanization, could be by 80% by 2050 to 2100. Young people want things to do. They also are very technology savvy. So electrification is very crucial. And why we need that is that we have to recognize that as the rest of the global world's demographic change happens, like, for example, China, you mentioned, countries will have to look at other centers for manufacturing and the development of many of the goods and services that the world requires. For example, countries that are aging, a lot of their funding is going to go into health, caregiving types of services. These are not exportables. They will have to import labor, for that matter, into these economies. So we have three things. The one is we got to break the dependency on enclave economies. That's one. We've got to see a lot more of the value of the enclave economies spill over into the rest of the economy. And one way to do that is to actually increase electrification. And electrification is a very important enabler of economic development and integration of Africa's labor force into the global economy. And that labor force is not just pure muscle, but it's also brains, it's talent, it's creativity, and that is what we can offer to the world if we can have a more enlightened view on these issues. The second is that the world needs new sources of labor going into the future. There are only two real places in the world where that labor, young labor, talented labor, is going to become a choice for countries to consider, particularly developed economies and also countries with investment potential, countries like China. It is Africa and India. And this labor force will have to increasingly integrate, not within the region also, but also within the global economy. And thirdly, we have to use our geopolitical partners in a more holistic way to think of breaking the enclave economies, but also diversifying, and use their technology, their finance, their capability to integrate it into this future, more, I would say, holistic economic development trajectory that we have to embark upon, on terms that we will say that that will allow more enduring and sustainable economic development to happen. We have to do this in a context in which a more carbon constrained work is going to be the de facto reality we have to operate under. South Africa is already facing that in terms of the fact that it is one of the most carbon intense economies in the world. And part of the role of the JETB is actually to decarbonize so that we can have a more competitive trade position going forward. I think that these are the more salient issues that should become more the mainstream debate than just this polarized debate, of gas versus renewables, which is largely being egged along by the fact that there's huge hypocrisy at the moment from those very quarters that are pushing the Green Deal, telling Africa that which already has a low carbon emission profile, stop gas, but deals are still continuing to be made. The question is whether they're going to string up a whole lot of deals in which the liability sits with Africans, while people who are asking us to supply emergency gas and increase that emergency gas in the long term, are finding other solutions as well to lower the dependency on gas.
That actually leads in very well to a question by Vivek. I think just to say we'll probably stay on an extra 5 minutes just to allow us to answer the 2 questions and make some closing remarks. But Vivek asks, with European diplomats quick to denounce the exploration and use of gas by African countries for its energy and social development, but European heads of state advocating and signing new gas infrastructure projects in Africa for exports to Europe, to fill the gap from reduced gas supplies, are we looking at the global landscape parroting a neo-colonial context? Don't know which of you want to.
Can I give a slightly...
Matt talked about neo-colonialism earlier, so you should ask.
Matt, over to you.
Okay, so I don't know what is the right label to put on this, but I think it would be fair to say that we've shown through our research that for many cases, and particularly for countries that are not producing now, accelerating investments in gas, particularly for export, creates long-term risks, right? So I mean, ultimately, if the acceleration is being driven by enhanced European demand in the short run, then there is a chance that for that short-term gain, African countries are taking on more long-term risk, right? And so and this is not something that we've modeled, but you could also see a world whereby global north countries might agree to, might recognize that risk and potentially compensate for that risk in the long run in return for helping African countries helping with energy security issues in the short run.
That would be good. Salim, there's a question from Yan Wang. As China, US, and Europe all initiated green and low carbon themed investment strategies in Africa, how are African countries taking advantage of these opportunities? And also, is there a preference from the African perspective towards money from China or the US or Europe? And can I ask you also to just make a concluding remark once you've finished with that question, and I'll hand over to Matt after that.
Sure. I think Africa, through the AU, has a forum for China and Africa, and so obviously the relationship with China is continuing, and I think we will see. It depends on how much of Chinese resources will be retracted, given the demands for the Chinese to focus a lot more on domestic issues and so on, and sub-regional issues. We are certainly seeing a decline in the financing of projects in the last year, also compared to previous trends, and that's really important. But China will continue to be an important trade partner. So will the European Union, and the US is busy ramping up its own relationship with Africa. If you remember that Blinken, who was in South Africa a couple of months back, put out the new Africa strategy. So clearly these big major blocks of countries and economies are looking to grow the interest. But it's not only Africa, there's also Gulf states, there's Turkey, there's Russia that's also very involved, and many other players. So countries are looking to do that on a bilateral basis with individual member states, for example, within the European Union. So, for example, Namibia is taking advantage of its relationship with Germany. Obviously, it was not always a good one, but relationships have improved since the offer of an apology for the colonial history that Germany has had with Namibia. But we see that, for example, on the hydrogen side, there's actually a special envoy being set up to deal with the upscaling of green hydrogen in Namibia, as an example. And many other countries are looking at, we have Saudi Arabia, for example, investing in green hydrogen in South Africa. They just announced a 10 billion deal, and Saudi Arabia is very active in the renewables program. I think what we also noticed in the study that Wei Shen did on China, that the capacity for Chinese private companies to play a bigger role in renewables can grow significantly, and there are discussions happening within China at the present moment on how the Chinese government can collaborate with private firms, because solar PV and not to such an extent with wind, because wind is a lot more diversified technology providers that exist in the world, but certainly with solar PV, China continues to be the dominant producer of this. There are also battery technologies, and there's electric vehicles. So China has a lot to offer. The terms at which it offers could be done on a regional basis, but it's likely that we don't have a unified political entity and one common currency, that individual countries will pursue this depending on their own needs for energy. Lastly, I would just say, that we've just had this polarized debate on gas and renewables. But if you look at, for example, East Africa, as you know, we've done some work even internally within ACF. There are a lot more astute and more efficient ways to solve the decarbonization challenge in East Africa, and the energy access and the cheaper energy solutions by more integrated power pool system, and have countries that are sitting with surplus generation capacity to be able to sell that on to other countries, which forfeits the need for new kinds of generation assets being invested in, that could be stranded assets, whether they're gas or renewables for that matter. So there are lots more other optimal approaches that we can take that we need to still put on the table. Lastly, I would just say that We should be championing more holistic approaches, look at our endowment on a more strategic level, look at all the endowments we have. And I can assure you that the solutions are not going to be limited to a narrow conversation that gas and fossil fuels are the solution. That actually we can exploit other endowments that we have and be more strategic about that. Thanks.
Fantastic. Thanks, Salim. Matt, do you have some concluding thoughts?
Yeah, just a couple of things. So what we often hear in developing countries, and I've experienced this in not just in Africa, but also in Asia and in Latin America, where I'm currently sitting early in the morning. A lot of the debate about fossil fuels versus renewables comes down to the question of whether those countries should, let's say, do low carbon, and a lot of the discourses around why countries should decarbonize more slowly because it's not their historic responsibility for emissions. The hard reality is that when for many of these countries that are dependent on export revenues for fossil fuels, the transition risks that they face are actually in a similar way to the physical climate risks that they face, are large and not within their control, right? So in this case, the risk faced by a Mozambique or a Tanzania or a Nigeria, for example, in relation to its exports is driven by the speed of the global transition. So we need to push past, I mean, the discussion about historic responsibility for emissions is incredibly important in my perspective, but it can't be the only thing that is driving the question about the speed of decarbonisation in any given country. Because if these issues are not taken into account, then the consequences, you know, for long-term development can be negative. Countries might miss out on the big opportunities that Salim was talking about, and ultimately we may end up with destabilizing economic and financial consequences that make both mitigation and adaptation investments more expensive. So there are significant opportunities arising now on the financing side, provided that countries are doing this sort of long-term planning. And you know, I hope that more of this will be factored into those decisions.
Fantastic. Thanks, Matt. And thank you to you both for really excellent contributions and for the very rich discussion. I think I've got a few thank yous. I'd like to thank Mohammed Anwar and Patrick Neary, who co-authored the 2 reports with Matt. From the ACF's perspective, it's been a great pleasure working with the Willis Towers Watson team, and we look forward to working together in the future. I'd also like to thank Jesse Ovadia, Padil Salimu, Simon Roberts, Antonio Adrioni, and Salsa Monjana, all of whom were part of the broader research consortium that contributed to this body of work. And it was also an absolute privilege for us to work with such great minds. A big thank you also to Douglas and Partners, and in particular Colin Douglas and Brett Cohen, who spent many a late night helping on the editorial and design side. And finally, a big thank you to Kelly Easton, the ACF's comms manager, who works all the magic behind the scenes and makes events like this possible, and to the Burners team. And thank you to all of you for joining us. Would encourage you to keep in touch.
And not to dismiss the value of Ellen Davies in contribution.
Thank you, Salim. But yeah, please do stay in touch. Let us know your thoughts on the webinar, on the research, and we're very keen as ACF to keep this conversation going. So have a wonderful day, and thank you, everyone.